The United States tax reform is one of the most significant developments in the tax world in the last 30 or more years. The last time the United States had a significant US tax reform was in 1986. And since then, there have been several changes to the legislation, but none of them compares to the Tax Cuts and Jobs Act that was enacted in law and signed by the president on December 22nd, 2017. The law impacts a lot of Canadians, be it Canadian individuals with interests in the US or investments in the United States, be it Canadian businesses. It does affect a lot of US expatriates that include US citizens and green card holders residing in Canada and outside of the United States. Obviously, the law affects any US residents who do reside in the United States. And as such, the impact of the reform is huge. Not all categories of taxpayers will benefit from the tax reform. However, there are a lot of positive changes, and the devil, as we always say, is in detail. For example, a lot of international tax provisions will make lives of US expatriates quite challenging. For example, the United States is moving toward territorial tax system, and as a result, there will be a mandatory repatriation that will be imposed on certain foreign corporations that have post-1986 accumulated earnings and profits, the closest approximation of which in Canada is retained earnings. As a result, for example, US shareholders of controlled foreign corporations, to the extent that the rules apply, will be required to pay transition tax, which is determined by using a special formula, but generally speaking, a 15.5% rate would apply to cash assets and 8% rate would apply to non-liquid hard assets. In a way, this provision retroactively subjects to tax those accumulated earnings and profits. And there are two cutoff dates, November 2nd and December 31st, 2017, which effectively eliminate any potential planning that taxpayers otherwise could have been engaged into to reduce their earnings and profits. In fact, the bill specifically states that, and the notice the IRS issued states that to the extent that taxpayers engaged in any planning that would potentially reduce earnings and profits or otherwise interfere with the transition tax, then obviously the IRS potentially may challenge that sort of planning. There are other provisions which will have significant impact. For example, everybody is speaking about the reduction of corporate tax rate. The United States, as we know, used to be one of the highest tax rate jurisdictions, with the highest tax rate being 35%. Now the bill reduced that rate to 21%. However, there are also some changes that would potentially make the effective tax rate of many businesses higher than it used to be. It especially applies to smaller companies. At the same time, there is expected to be more investment in the United States, and if before multinationals and the businesses engaged in cross-border trade, for example, Canadian businesses with US subsidiaries, focused on repatriating cash and income from the United States to Canada so that it would be subjected to lower tax rate, they would lose now that incentive, generally speaking, because there probably would be more incentive to keep those profits in the United States. Some of the other important provisions of the new legislation include, for example, a change of the definition of the US shareholder and a repeal of the 30-day rule for inclusion of income into Subpart F income of a controlled foreign corporation. If before, for example, when a US shareholder would have an interest in a controlled foreign corporation that would be considered a CFC, and then they would realize this happened and wanted to get out of it, No inclusion would follow as Part F income to the extent that 30 days, the US shareholder held an interest in that corporation for less than 30 days. Now that rule is eliminated, and as a result, on any given day, the pro rata share of the US shareholders' Part F income would be includable in taxable income and as a result being taxed. The definition of US shareholder changed, and that as it used to be that the US shareholder would be considered a US person who holds 10% or more of voting power in the controlled in foreign corporation. Now the definition was expanded to include not only vote but also value. What it means is for many structures in which the persons, US persons who had an ownership in foreign corporations and were not considered US shareholders because they did not have voting stock, for example, they may have had preference shares. Now they potentially may be considered US shareholders, and that would necessarily potentially mean in some border cases where a foreign corporation would be not considered a controlled foreign corporation, potentially now it may be considered as such, which then would make it subject to US anti-deferral Part F regime. Another important change, which also is worth mentioning, is the change or rather repeal of the ownership attribution rule, under which there was an exception for downward attribution from certain foreign entities. And again, all taxpayers, US shareholders, to the extent they have interest in foreign corporations, need to reevaluate their structures, because potentially now they may find themselves in a situation where they will have a CFC when otherwise it was not due to those ownership attribution rules. There are other changes, obviously quite important both domestically and internationally. Section 482 transfer pricing regime has now been changed to add realistic alternatives available to taxpayers in determining what strategy or transfer pricing methodology to use when shifting or transferring intangible property. So now the IRS will have the power to use the alternative, realistic alternatives approach to value the intangibles, and that's going to essentially prevent multinationals from transferring intangible property outside of the United States, which used to be one of the popular strategies in the past. There are a lot of other important changes on the individual tax side. The doubling of basic exclusion amount for estate and gift tax purposes from 5 million per person to 10 million, and then for couples double that amount. That now, of course, would allow additional planning opportunities, but within a short period of time, whereas the provision sunsets after 2025. And there are several provisions that have that sunset time limit. As a result, there may be both planning opportunities and also some action points that taxpayers may engage in to make sure that they take full advantage of the new provisions, and so that they prepare themselves for potentially negative impact of other provisions. With that, we are going to discuss a lot of different changes in detail in other short segment videos. And hopefully you will be able to take advantage of understanding the rules, talking to your US tax advisor, and identifying and determining any planning opportunities, and also making sure that you comply, especially in the view of the 2018 tax season.